The exponential moving average is an important technical indicator. It is a trend indicator, so it tries to confirm the direction and strength of a price. It does this by smoothing out the various price fluctuations over a period of closing prices with more weight on the most recent closing price. So to better understand an exponential moving average, let's look at the equation. Okay, so EMA will equal exponential moving average. C is going to equal the closing price of the current price period that we're looking at. EP is going to be the previous period's EMA, or exponential moving average. K will be an equation itself, which is 2 divided by n plus 1. And n is going to be the number of price periods that we're looking at, so the total number of closing prices. So let's see an example of this. For this example, we're going to look at the 5-day EMA of the S&P 500 from mid-October to mid-December. We're going to specifically calculate the EMA for December 2nd. To do that, we are going to subtract the closing price of December 2nd by the previous EMA, so the EMA for December the 1st. And when we do that, we get $35.80. We are then going to times that by K. If you remember, K is a separate equation, which is 2 divided by n plus 1. N is the total number of price periods that we're looking at, which is 5 days. So it's 5 plus 1. 2 divided by 5 plus 1, 2 divided by 6, which is going to equal 0.33 repeater. So we're going to multiply that by 35.8, and what we get is 11.93. Then we're going to add the previous period, so December 1st exponential moving average, which again is $3,633.20. This gives us an EMA for December 2nd of $3,645.13. So that is this point right here. This is $3,645. And if you look at this, it lines up pretty closely with that amount. Looking at the previous example, you may ask yourself, what if we don't know the previous period's exponential moving average? Typically, you won't need to worry about this. Most charting applications, such as the ones on tradingview.com and investing.com, will automatically calculate the exponential moving average for you. But for the completionists in us, if we do not know the previous period's exponential moving average, we simply calculate the moving average for the number of periods under observation. For those who don't know what a moving average is, I will add a link in the description for my video explaining the moving average, but a quick overview. Basically, with the moving average, you're adding the closing prices for the amount of number of time periods that you're looking at. You're adding them together, then you're dividing it by the number of time periods that you're choosing to observe. So let's see an example for this. For this example, we are once again going to calculate the exponential moving average of December 2nd on the S&P 500. But instead of using the previous period's exponential moving average, we're going to assume that we don't know that number. So since we do not know that number, we're going to do a 5-day moving average of the price period before December the 2nd. So that means we are going to calculate the 5 closing prices before December the 2nd, and then we're going to divide them by 5 because we're looking at 5 different price periods. This gives us a number of $3,637.58, or rounded up to 60 cents. And that will be the replacement for the previous period's exponential moving average. If we calculate that into the equation, which again is the closing price minus the previous period's exponential moving average, which we're going to use as the moving average, then times it by K, which if you remember from the previous example is 3 repeater, and then add the previous period's exponential moving average, which again will be the moving average. We get $3,648.06, which is fairly close to the number that we got when we use the previous period's exponential moving average. Obviously, it's going to be a little different because there's different numbers that we're using, but the previous period we got was $3,645.13. Like the moving average, I wanted to show you that you do not need to calculate every point to draw your exponential moving average line. In fact, I wouldn't recommend it. Most charting applications will do the calculation automatically for you. So basically you click on the indicator button here, type in moving average exponential, and there you go, automatically calculate the exponential moving average line for you. The default for this website is 9 trading days, but you can change that to however many trading days you want. Click on this icon right here and adjust the length. The length will correspond to the amount of trading days you want to calculate. So if you want to do a 15-day EMA, bump up the length to 15. And there you go, there's your 15-day EMA. That being said, what is a practical strategy for the exponential moving averages? Now, I wouldn't recommend trading with only the exponential moving average. You should use many other technical indicators in conjunction. But if you're to only use the exponential moving average, here's 2 strategies I've found that are successful. Buy an index stock such as the S&P 500 when the close crosses above the previous day's 120-day EMA. Sell essentially at the opposite. So when the close of the S&P 500 crosses below the previous day's 120-day EMA. The second strategy I found useful is to calculate a 12-day EMA, which is your short-term EMA, and a 50-day EMA, which is your long-term EMA. And you're going to buy when the short-term EMA crosses above the long-term EMA, and then you're going to sell when the short-term EMA crosses below the long-term EMA.